Now, one of Donald Trump's key changes to the Dodd-Frank regulations in his recent executive order is to eliminate something called the fiduciary rule. So this is where it gets both simple and complicated. I'm going to try to break it down the best I can for you. But again, there's a lot of components to this. Now, on its face, it does seem fairly simple. Basically, the rule says it would have enforced investment advisors and workplace retirement plans like 401ks to operate in their clients' best interests. Well, look, that makes sense, right? Yes, when you go and try to get advice from these financial advisors on what to invest your retirement savings on, you want to make sure that they are actually working for you. Makes all the sense in the world, right? Do what's in your client's best interests. Why we even need a rule for this, I don't understand. Or maybe I do. It's because people are greedy fucks. They're going to do whatever they can to make an extra buck. In fact, instead of giving you sound advice, some of these advisors would actually recommend high-cost, high-risk products so they can get some kickbacks and perks from the companies they invest in. And see, that's why we needed those rules, because people would screw other people out of their retirements. In fact, the Obama administration estimated in a 2015 report that the conflicts of interest, these conflicts of interest, where you're actually getting, these advisors are getting kickbacks from companies that they tell their people to invest in, may have cost retirement savers up to $17 billion every year. Jesus, man. Again, this is why we need rules. Rules like the fiduciary rule, which was finalized last year. Now, it was an effort to try and stop this whole thing and force these advisors to steer you towards safer investments instead of riskier investments, unless, of course, you were fully willing to commit to that level of risk. If you knew what you're doing, okay, caveat emptor, right? Okay, buyer beware. You know what you're getting into, and you still want to invest in this company, great. Okay, that's up to you. The risk is on you. But most people don't know. Most people don't know what they're investing in. They look at something and go, I don't know, I'll invest in that. That looks good. Is that growing? Great. They don't know. They don't know. And what working person with a 401k has time to go and follow every little move on the stock market? Not a lot. Not a lot. Now, you had, let me give you something here from Gary Cohn. Now, Gary Cohn, former Goldman Sachs president and director of the National Economic Council for Trump, put it this way. The fiduciary rule, in his opinion, was like putting only healthy food on the menu, because unhealthy food tastes good, but you still shouldn't eat it because you might die younger. But see, that right there is not a good analogy. See, retirement is not a diet. It's what you live on when you're no longer working, when you're no longer bringing in a regular income. You kind of need this to live. It's the difference between a comfortable retirement and abject poverty. And look, we saw what happened when there wasn't a guaranteed retirement for people in the past. The elderly were living on the street and moving back in with their families because they literally had nothing. And that's why we have Social Security, by the way. You might bring that up. Yeah, Social Security, we still have that, right? Well, we do. But even that's not enough. There are a lot of elderly people living on Social Security that hardly make enough in benefits to survive. The costs, the benefits from Social Security don't exactly scale as well to the costs of living. And even though we have cost of living adjustments nearly every year, or at least we did have them nearly every year, at least it would go up a little bit. But again, not very much, $20, $40, $50. Social Security, not quite enough. And so why Donald Trump thinks it's a good idea for these investment advisors to continue steering people towards riskier high-cost plans that could end up failing and making people lose what little retirement benefits they have, I don't know. I think it might have something to do with, well, the money. But I don't know. Then again, look, maybe these plans might help with the stock market rallies. I mean, that could be, right? And maybe Donald Trump, in his infinite wisdom, is expecting the stock market to go, I'm going to make the stock market grow. It'll be fantastic. I'll be the most, the biggest stock market president God ever intended. Believe me. Maybe. I don't know. Look, I hope so. I hope it turns out to be great. I hope the stock market goes up and everybody's 401ks do awesome. That would be fantastic. I'm for that. Because again, higher risk equals higher reward. But again, for a lot of people who don't understand this, you are risking your retirement. Because if the stock market goes down, you could lose everything. And, regular people, they're not day traders. And so that's why we go to those investment advisors in the first place. But if they're incentivized to sell us higher cost, riskier stocks so they can make an extra dollar, well, that's disturbing. That's not right. So again, why does our president think that it's such a great idea to roll back this rule that will help people seeking to save for retirement in safe retirement accounts? Again, I think you already know. The Intercept reports that on the same day that Trump issued this fiduciary rule executive order, he met with his White House jobs panel headed by Stephen Schwarzman. Schwarzman is the CEO of the world's largest private equity firm, the Blackstone Group. And they've been involved in some shady shit. Now, during that meeting, Trump reportedly told Schwarzman that, quote, "We're getting rid of your regulations." Now, what regulations are we talking about? Not only the fiduciary rule, which is the big one, actually. But I wonder what else Trump is going to get for this gigantic gift to Blackstone. Well, we'll get into this. Now, looking at Blackstone's giving, and this is political donations. Now, they actually gave a lot to not only Hillary Clinton, actually they gave the most to Hillary Clinton in this cycle, interesting, but also to Marco Rubio and low-energy Jeb Bush. Now, even though they gave more to Hillary Clinton in this cycle, they still ended up giving it twice as much in campaign donations or bribes to Republicans than they did to Democrats. So I think this is Trump, thanks to his advisors, going in and them saying to him, hey, you guys, you need to repay our donors by getting rid of this regulation. This is the exact type of deregulation that the Blackstone Group has been wanting for a very long time. In fact, Schwarzman said in an analyst call, quote, "In life you have to dream, or you have to have a dream. And one of our dreams is our desire and the market's need to have more access at retail to alternative asset products." Now, what the hell are alternative asset products? Again, this is where it gets a little complicated, so please stay with me on this one, because it's important. Basically, alternative investment products are private equity, hedge funds, managed futures, real estate, commodities, and derivative contracts. Now, furthermore, most alternative investment assets are held by institutional investors or accredited high net worth individuals because of the complex natures and limited regulations of the investments. So look, I know that sounds like a bunch of jargon, right? And basically, you're saying that these investments are not normal investments, they're private investments, and they're privately owned high-risk investments with little regulation and oversight. So, again, regular investments that are safer are things like stocks and bonds. There's a lot of regulation on those, but not a lot on these alternative asset products. So, and of course, they can be quite complex. And it's not something that most people would want to base their nest egg on. Now, The Intercept further explains that traditional pension funds invest heavily in private equity. But defined contribution plans like 401ks have traditionally not invested in the asset class because 401k holders choose how to invest their money and can move in and out of funds quickly. They don't fit mechanically with private equity, which locks in investors over several years. Also, private equity usually asks for large minimum investments, not less than $5 million to open their funds to investors. Now, that means big companies will be able to buy in or lock in to these private equity firms because they have those kind of assets that they can put towards retirement. Now, it says since most retirement plans are 401ks instead of pensions now, because that changed. Private equity wants to get into that market because there's literally trillions of dollars in potential capital waiting to be exploited. And they can't wait to get into it. And since Americans hold about $6.8 trillion in individual retirement plans like 401ks, Wall Street is essentially salivating at the chance to get into this and to get their hands on this money, on your retirement money. This whole thing has been called the Holy Grail quest by the industry. If advisors start taking these riskier plans, it would put more money into private equity. In fact, they say 5% of the estimated $6.8 trillion in growing in 401ks is akin to about $340 billion. Now, this is from Aline Applebaum, senior economist at the Center for Economic and Policy Research and author of Private Equity at Work. Now, again, this is a lot of jargon, right? So if you're still with me, great. Now I'm going to tell you why it's a bad idea. Now, these investments are far riskier than 401ks. And contrary to popular belief, private equity firms do not actually outperform the market. Fees are often opaque and much larger than those in passive funds, usually extracting 1% to 2% of the total capital investment and 20% of the profits. In fact, there was a 2014 SEC study that found that over half of the private equity firms examined shifted costs to benefit themselves, like billing investors for legal and compliant costs without their knowledge, or forcing investors to pay for consultants who are actually former employees of the companies. You also had giant fees that essentially guarantee private equity profits regardless of the performance of the portfolio. So if your portfolio goes down the shitter, they still make a buck. They don't care how your retirement fund works. They don't care if you lost money. They don't care if you gain money. Well, maybe they care if you gain money, because then they get more money. But regardless, these people are fucking getting paid. Not only that, but private equity firms have been accused of deliberately reporting exaggerated returns in order to get more fees. And even if the returns were legitimate, which some are not, this would still put millions of retirement dollars into an industry that has been criticized for predatory versions of capitalism. For doing predatory capitalism, man. And what do I mean by that? Well, some of these investment firms, remember, these are hedge funds that manage this retirement money. Well, these hedge funds will also pull like a Bain Capital. They'll go and buy up companies and then rip them apart after loading it with a whole bunch of debt, driving it to bankruptcy, ripping it apart, and selling off the assets. Now, when these companies go and do that, who do you think suffers? Well, the workers, the same workers that would end up having 401ks. They either lose their jobs or they end up with less benefits because these companies are only looking out for short-term profits. And if they wreck a company which you're invested one with a 401k, oops, there goes your retirement. Gone. And look, that private equity firm doesn't give a shit. They still made their money from you and then some by buying up that company, loading it with debt, and then selling it off. And if that ruins your retirement because you were told to invest in that company, sad day for you. That's how they screw you, man. And when private equity firms really start getting into these 401ks, individual investors could start using that money to fund an industry that's going to end up sucking the value right out of their employees. And this is by eliminating that fiduciary rule. These advisors will no longer be required to act in the best interests of their clients when promoting target funds. That enables them to include private equity firms, regardless of what the fee structures are or the threats of losses. Now, I've got one more thing to mention here. Advisors could also receive hidden kickbacks for including these investments in target funds. But the thing that I want to mention too is a study from researchers at Indiana University, the University of Texas, and the Federal Reserve. Now, it was done last October, and it said plan advisors routinely present limited choices to 401k investors to steer them into unnecessary or risky options. This favoritism benefits affiliated funds, and with private equity perks in the waiting, advisors would yet have another incentive to tout these products. And look, all of this, right? All of this, this is about a rule meant to protect you in your retirement. And this is that they got rid of that because they don't care about it. The reason that I talked about this whole thing at length and probably lost half the people watching because it got so in-depth and detailed is that somebody's got to break this down. Somebody's got to talk about this, because there's still so many people out there that hear the word regulation and think regulation bad. Republicans tell me regulation bad. No, regulation not bad. Regulation actually helps you protect your retirement fund from given to firms, or from being given to firms that do not have your best interest at heart, are there just to extract money and wealth from you. And look, Donald Trump likely had no idea what he was signing when he got rid of this rule. But Steven Schwartzman did. Steven Mnuchin probably did. Gary Cohn and all the other Goldman Sachs alums that Trump brought into his cabinet, they knew what he was signing, even if he didn't. If you think anybody in the Trump administration is looking out for you and your best interests, you're wrong. And I'm afraid that only major financial pain or another financial crisis like we had in 2008 will be the thing that's going to wake up most Trump supporters. And that, I don't want that to happen. I don't want that to happen. I want the economy to do tremendous. I want it to do fantastic. But I have this feeling that it's not, and that this whole house of cards that they're building is going to come crashing down on all of our heads. Don't say we didn't warn you. Hey everybody, thanks for watching this video. If you want to see more like this, please hit the subscribe button below. And if you want to support truly independent progressive media, please consider becoming a patron at patreon.com/TYTNation.